Let me be brutally direct with you right now. Before you even think about reaching for that pause button, gold, silver, and oil are sitting at some of the most critical technical junctures I have seen in years. And the overwhelming majority of people watching this video are positioned completely wrong. Not slightly wrong. Not almost right. Catastrophically account-destroyingly wrong. And the reason is not that the information was unavailable. The reason is that you have been listening to social media personalities who have never managed real money at scale. Mainstream financial analysts who are paid to manufacture liquidity for institutions, and your own emotions dressed up as conviction. The charts have been screaming the truth for weeks, and most of you have not been listening. That ends today. In this video, I am going to give you the exact mathematical price targets for gold, silver, and oil, the upside levels, the downside levels, and the timelines attached to each of them. This is not speculation dressed up as analysis. These are confluences derived from parallel channel construction, bear flag identification, and support and resistance mapping that has been proven out on these very charts, on these very assets, in real time. Pay attention, because this kind of clarity is extraordinarily rare, and if you miss it, the market will not give you a second warning. Right now, before we go a single second further into this analysis, I need you to hit that subscribe button. I am not asking you as a courtesy, and I am not padding this video with a soft, friendly reminder. I am telling you plainly that the level of technical market analysis you are about to receive in this video is the same quality of work that institutional desks pay tens of thousands of dollars per month to access. You are getting it for free right now on this channel. And the only thing standing between you and that information pipeline is a single click. If you are serious about your financial future, if you are genuinely committed to putting the odds in your favor rather than gambling on headlines and emotions, then you subscribe now, you turn on notifications, and you treat this channel like the financial resource it actually is. Let us establish something fundamental before we dig into the individual charts. Because without this foundation, the targets I am about to give you will feel like arbitrary numbers, rather than the logical, mathematically derived conclusions they actually are. The financial media ecosystem that most retail investors swim in every single day is not designed to make you money. It is designed to generate engagement, manufacture emotional reactions, and ultimately serve the liquidity needs of large institutional players who need a willing and consistently wrong counterparty on the other side of their trades. When you go on social media and you see breathless posts about gold going to $10,000 this year, or oil exploding because of geopolitical escalation, or silver being the most undervalued asset in human history, understand that these narratives are almost always perfectly timed to get retail investors positioned on the wrong side of a major move. The institutions need someone to sell to at the top and someone to buy from at the bottom, and that someone is you. Every single time you make a decision based on a narrative rather than a chart, technical analysis is not magic. It is not astrology with a financial veneer. It is the disciplined, systematic reading of price behavior, the aggregate output of every buyer and seller in the market, expressing their true conviction through actual capital. When you look at a chart properly, when you identify the parallel channels, the bear flags, the support and resistance zones, the inside bars that signal consolidation before continuation, you are reading the closest thing to honest market truth that exists. The chart has no position. The chart is not long gold hoping it goes up. The chart is not short silver with a thesis to defend. It simply records what happened. And if you know how to read it, it gives you a probabilistic roadmap of what is likely happen next. That is the framework. And right now, that framework is telling a unified, consistent, and sobering story across gold, silver, and oil simultaneously. When three major assets are all painting the same structural picture at the same time, you do not ignore that, you pay very close attention, and you position accordingly. The confluence of identical technical patterns across multiple asset classes is not a coincidence. It is the market communicating a macro message with unusual clarity. Bear flags, Parallel channels. Inside bar consolidations, these structures are appearing on all three charts right now, and they are all pointing in the same direction. The short-term price action in each of these assets is constructive, meaning there's upside left to play, but that upside is a setup for the real move, which is down. The sophisticated investor sees both parts of that equation simultaneously. The retail investor sees only the short-term rally and concludes that the trend has reversed, that cognitive failure is expensive, and it is about to get very expensive for a lot of people who are currently sitting in long positions in these commodities with no exit plan, no defined risk, and no understanding of where these charts are actually pointing. Let us begin with oil, because oil is actually the most straightforward of the three right now, and it gives us the cleanest example of exactly how a narrative-driven retail investor gets destroyed by a chart-driven market. Think back to just a few weeks ago. Go on social media right now if you want to revisit the carnage. You will find post after post, video after video, commentator after commentator screaming that oil was going to keep climbing, that geopolitical tensions were going to drive energy prices through the roof, that the fundamentals were overwhelmingly bullish, the rhetoric was apocalyptic, it was going to be end of the world demand for energy, and anyone who was not long oil was either an idiot or a coward. The chart, meanwhile, was telling a completely different story with complete composure and zero emotion. What the chart showed was a classic bull move followed by a consolidation into a bear flag, an upward sloping channel forming after a significant downward move, which in technical analysis is not a sign of strength but a sign of exhaustion. The topping tail was visible. The inside bar followed with textbook precision. The break of that upward sloping parallel to the downside was the confirmation signal, and it came in exactly where the structure predicted it would. The call was clear. Oil was going lower, the bear flag had broken, and the geopolitical narratives were nothing more than noise obscuring a chart that had already made up its mind. So where does oil go from here? The first downside target is clear and specific, $77. That is your near-term level, the first area where you would expect the market to find some meaningful support ton, potentially stage a bounce. Do not confuse that bounce with a trend reversal. It will be a temporary pause within a larger downward structure beyond that initial target. The real destination, the one that will take longer to arrive, but is arguably more significant, is $67 and change. That level is not arbitrary. There is a price gap on the chart at that level, and market structure dictates the gaps get filled. It may not happen next month, and it may not happen this quarter. The timing on this final target is tied to the broader trajectory of the U.S. economy. And as economic weakness becomes increasingly undeniable over the coming months, the demand destruction that drives oil toward that $67 gap fill will accelerate. The patient, disciplined investor marks that level, watches for confirmation, and acts accordingly. Everyone else will be surprised. Now let us talk about gold, and I want you to clear your mind completely of whatever bullish thesis you may have absorbed from the financial media before we do this, because gold right now is one of the most beautifully constructed, deceptive charts I have seen. And by deceptive, I mean that it looks bullish on the surface while the underlying technical structure is unambiguously bearish over the medium term. This is the kind of setup that separates professional traders from retail investors, because the professional sees both the near-term opportunity and the longer-term danger simultaneously, while the retail investor sees only the part that confirms what they want to believe. Here's what the chart is actually showing. There is a parallel channel structure on gold that has been repeating its behavior with extraordinary precision. The angle of the current incline matches the angle of a prior incline that preceded a significant breakdown almost perfectly. The inside bars are appearing in the same relative positions. The pattern of lower highs and lower lows is establishing itself within the broader structure, even as the short-term price action appears constructive. This is a textbook representation of a downtrend dressed in the clothing of a consolidation and partial recovery. The smart money knows exactly what this is. The retail money will find out the hard way. So what does this mean in terms of exact numbers? In the near term, Gold has an upside target of $5,000 to $5,100. That is a very specific range derived from the parallel channel construction. The upper parallel of the channel, combined with a prior resistance zone that now acts as a confluence target, points directly to that 5,000 to 5,100 area. This level also aligns with a prior zone that acted as resistance before the breakout, then became support, and has now been broken again, meaning that when price returns to it from below, it will face the full weight of that prior level acting as resistance once more. $5,000 to $5,100 is where gold's near-term rally terminates. After that rally exhausts itself and the breakdown begins, and it will begin because the structure demands it, the next major downside target is $3,900. That level is not a guess. It coordinates precisely with a prior significant low on the chart, and within the parallel channel framework, it represents the next logical resting point for price as the downtrend asserts itself. But 3,900 is not the final destination. The maximum downside target, the level where this entire corrective sequence ultimately concludes before the next genuine bull cycle in gold begins, is $3,500. That is the number. $3,500 is where the major parallel structure finds its floor, and it is from that level that the next sustainable, fundamentals-driven bull move in gold will eventually launch. The gold bugs who ride this asset up to 5,000 feel vindicated, tell everyone they were right, and then hold all the way back down through 4,000 and beyond to 3,500. Those people exist. They're out there right now, and the chart is going to take their money with mechanical indifference. The question is not whether this will happen. The question is whether you are going to be on the right side of it when it does. Silver is where things get genuinely fascinating, and I use that word in the same way a surgeon might find a particularly complex operation fascinating, with clinical detachment and complete focus on the outcome rather than the spectacle. Silver right now is painting a picture that mirrors gold in its structural logic, but with its own specific price levels and, critically, a much tighter and more defined timeline that every serious investor needs to understand before the window closes. Let us start with the near-term picture. Silver has short-term resistance sitting at $82. The current structure is a bear flag, a down move followed by a flattish to slightly inclining consolidation, that is, building up pressure for the next leg lower. This consolidation has found support in the $64 to $66 zone, and the counter-trend bounce within the flag is doing exactly what bear flag bounces do. They look convincing enough to attract new buyers while the sellers quietly reload their positions. The resistance at 82 is where that dynamic plays out, where the buyers who chased the bounce meet the sellers who were waiting for exactly this level. Now, here is where the parallel channel analysis on silver becomes particularly important, because it extends the story beyond the immediate resistance and into a much larger, much more consequential move. When you connect the significant lows on the silver chart and drag the parallel up through the highs, what you get is a channel that suggests silver could actually push through that $82 resistance level before the next major leg down begins. That would be the move that draws in the maximum number of retail buyers, the breakout traders, the momentum chasers, the people who have been waiting for silver to clear 82 before committing, right before the rug gets pulled. The market is not cruel because it wants to be. It is cruel because that is how liquidity is generated. So where does silver ultimately go? The lower parallel of the channel gives us the answer with a specificity that is almost uncomfortable to state plainly. Silver's maximum downside target is the $50 area, $50. And the timeline attached to that target is not vague or open-ended. The channel structure points to the July timeframe as the period when price meets that lower boundary. We are in mid-April right now. That means you have approximately 2.5 to 3 months before silver potentially hits its major downside target. June is where the structural pressure begins to intensify meaningfully, and July is the month where the lower parallel and the price action converge at that $50 zone. This is a time-stamped, mathematically derived warning. Silver to $50 by July is not a perma-bear fantasy. It is what the chart is showing, and the chart has no reason to lie to you. The people who are currently bullish on silver because they have heard that it is undervalued relative to gold, because they have read that industrial demand is going to drive prices higher, because some influencer told them that silver is the most manipulated and therefore most explosive asset in the commodity complex. Those people are going to be deeply, painfully wrong over the next several months. And they will be wrong, not because the fundamentals are irrelevant, but because they are looking at the wrong information at the wrong time through the wrong lens. The chart is the lens. Right now, the chart is saying that $50 by July is the destination. You have been warned. Let me now pull back from the individual assets and give you the framework that ties everything together, because the real insight here is not just the specific numbers, it is the methodology that produced those numbers and what it means to have three major commodity markets all painting structurally identical pictures at the same time. When gold, silver, and oil are all simultaneously displaying parallel channel breakdowns, bear flag confirmations, and inside bar consolidation patterns, this is the market speaking with unusual collective clarity. It is not a coincidence. It is a confluence. And confluences are the closest thing to certainty that financial markets ever offer. The concept of a confluence in technical analysis is simple but profound. When multiple independent lines of technical evidence, a trend line, a support level, a parallel channel boundary, a prior resistance zone, all point to the same price level simultaneously, the probability of that level being significant increases dramatically. Each individual signal carries its own weight. When they converge, the combined weight is something qualitatively different from any single signal on its own. The targets I have given you today: 5,000 to 5,100 on gold, 77 and 67 on oil, 82 and then 50 on silver. These are not numbers I plucked from the air. They are each the product of multiple confluent technical signals pointing to the same level at the same time. That is why they carry the conviction they do. Now, here is the part that most investors intellectually understand but emotionally fail to apply. No analysis, no matter how rigorous, produces certainty. Charts can fail, patterns can be invalidated, geopolitical shocks can temporarily overwhelm technical structure. News events can trigger moves that are technically irrational but very much real. What technical analysis gives you is not a guarantee, it is a probability distribution that is tilted in your favor. The professional investor does not need a guarantee. The professional investor needs the odds on their side consistently across hundreds of trades over time, with defined risk on every position so that the losses are small and the wins are large. That is the entirety of the game at the highest level. You are not trying to be right 100% of the time. You are trying to be right significantly more often than you are wrong, with position sizing and risk management that ensures your wins outweigh your losses, even in periods when the win rate is lower than usual. That discipline, applied consistently to charts that are telling you this level of clear, convergent story, is how wealth is built in markets. Everything else is gambling with extra steps. The person who acts on emotion, who buys gold because it makes them feel safe, who sells oil because the news scares them, who chases silver because someone on the internet told them it is going to 10,000, that person is the liquidity provider for everyone who does this the right way. Do not be that person. The charts are showing you the map. Use it. You now have the exact targets. You have the framework. You have the timeline. Gold to 5,000 before the reversal, then down to 3,900, and ultimately to 3,500. Oil to 77 near term, 67 is the final gap-filled destination. Silver with a near-term ceiling around 82, potentially a brief push through it, and then a relentless move down to $50 by July. That is the complete picture. That is what the charts are telling anyone who is willing to read them honestly instead of looking for confirmation of whatever they already believe. Now, I want to challenge you directly. You watched this video, you received this analysis. What you do next is the thing that defines you as an investor, the people who absorb this information. Think that's interesting. Close the tab. and go back to scrolling social media for the next emotional hit. Those people will be in the comments of some other video in 3 months asking why gold dropped from 5,000 and why silver is at $52 and what happened. The people who take this seriously, who mark these levels on their charts, who build their positions with discipline and manage their risk with precision, those people will already know exactly what happened because they were warned today. Subscribe to this channel right now if you have not already done so. Hit that notification bell so you do not miss the follow-up analysis as these targets approach and price action develops. Drop your questions in the comments below. What are you watching? What is your position? Where are you uncertain? Because the comment section of this channel is one of the few places on the internet where you will get honest, chart-based answers rather than the usual noise. And share this video with anyone you know who is currently holding gold, silver, or oil positions without a clear exit strategy, because you may be doing them the most important financial favor of their year. The market is not going to wait for you to get comfortable with the truth. It never does. Act accordingly.